Alrighty. So in today's video, we're going to be talking about a pretty interesting strategy, and it's called the 112 option strategy. So I've had a number of people that actually reached out to me and to ask me to actually cover this strategy, right? So at first, I didn't exactly know what is this 112 option strategy because it is not that of a mainstream kind of a strategy. Because if you notice the other strategy names, they actually have a name like iron condor, credit spread, so on and so forth, right? This is the only strategy that has a number involved to it. So I was curious to actually find out what exactly is this option strategy. So I did a deep research into this, and here this video I'm gonna go to do a deep dive into this, right? I'm going to get into what exactly is this 112 strategy, whether you should trade it, and if you choose to, how to trade it as well. All right, so let's dive right in. So first of all, what exactly is this 112 strategy, right? What is this 112 method? So this strategy, basically this number 112 coincides with the legs that you have, right? What kind of options that you have for each of this, right? So for example, this method consists of one long put that is out of the money. So as you can see here, out of the money again for the put side is anything that is below the current market price, right? So down here, you have the current price. So anything below that is called out of the money. So you have one long put that is out of the money, and then you short a put option that is below this long put. So it's further out of the money. And then you have two short puts that is very far out of the money, right? So just from this alone, you notice that this construct has actually three short puts, right? Three short puts and one long put. Now, if you were to just look at this, people might get a little bit confused, right? How come there's three short puts, right? And it seems kind of dangerous to have that many short puts in one strategy. So I want you to think of it as this, right? Just think of it as two short puts that is financing a long put spread, right? So basically from this two short puts down here, so what you're doing here is you're selling the put options here to get some premium, right? So you're going to get some premium down here. And with this premium, you're going to actually purchase a put debit spread. So this put debit spread is a little bit like a hedge, right? So if you think about this strategy, it's very similar to the put ratio spread, right? So the put ratio spread is basically something like this, right? So the put ratio spread does not have this two short put out of the money, right? That's further out of the money. Instead, down here, you have two short puts, right? So this is the put ratio spread. Now, the other way to do the put ratio spread is that you can actually spread out the short put, right? So for example, you don't need to have two short puts at one place. So instead, again, let me just remove this. So instead, maybe you have another one put option down here, right? So if you have one put option down here, this one will really give you some premium. With this premium, again, you finance the debit spread, right? The put debit spread. So as you can see, it's pretty similar. Now, why is there two short puts down here instead of one? So the whole idea with this strategy is that it's trying to get a high win rate, a high probability of win rate. And that is why it's trying to go with a short put that is very, very far out of the money, right? So let's say, for example, this current put ratio down here, right? This is a put ratio spread where you have the short puts that is split up, right? One slightly further out of the money. Now with this down here, this premium which you receive could very nice just be able to finance this put spread, right? Let's say, for example, you get $2 for this, okay? So if you get $2 for this, maybe you can buy a put spread down here that costs roughly about $1.50, right? So the spillover is a net positive of a 50 cents credit for this put ratio spread. Now, what this strategy is trying to do is that it wants to push this short put out because it wants to get a higher win rate, right? So maybe down here, this might be somewhere around 20 deltas. So 20 deltas would be closer to the market compared to the one down here. So based on this strategy, what they're really trying to do is to go for a very, very far out of the money delta, a very, very low delta of somewhere around 5 deltas to 10 deltas, right? Because if you go very, very far out of the money with 5 to 10 deltas, so what happens is that now you have a higher win rate, right? Because the chances of the market coming down to test this short put is not as high. So let me just remove all this drawing again, just to make it even clearer. So again, we have the one short put down here for the normal put ratio spread. Now, the problem with this is that when you try to push it out down here, and let's say you only have one put option down here, the problem down here is that you might not actually get that much credit, right? So the credit maybe this time would be only $1.20. So you notice that $1.20, and you want to buy this one down here, and this one, let's say for example, again, is still at $1.50. You can't get a good enough credit, right? Because you have pushed it too far away. So in order to compensate this, what they do is they sell two short puts. So this way now, instead of getting $1.20, what you have right now will be $2.40. So now you have much more premium to finance this put debit spread that you're going to buy. So this is the whole idea of this strategy, right? You're adding the additional short put so that you can go much further out of the money, increase your probability of profit. But the downside to this is that you actually also increase your risk. Because right now you don't just have one short put, you have two short puts, right? So that is double the risk. So this is the whole strategy that this 112 is all about. So this is a premium selling strategy that has a very high win rate. So the next question you might be wondering is, should you actually trade the 112 strategy? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So in order for you to understand whether you should trade this strategy, you need to first understand the pros and cons of this method, right? So let's start off with the pros. So the pros of the 112 strategy, there are a few of them. So the first one is that you have a very high win rate, right? So as you can see down here, this one that I've constructed is above 95%, right? 95.88%, right? In certain cases, you can go even higher than that. But what that means is that you really need to push your two short puts, which is down here, much further out of the money, right? So you're going to go even further out in order for you to get a very, very high win rate. So this is one of the pros of the 112 strategy, right? So most of the time you put it on, you're going to be profitable. And because you have a very high win rate, this also leads to having a very short losing streak. So this is very important to understand as well, because when I'm looking at any strategy, I also want to understand the losing streaks that's involved with the strategy, right? Because we humans, we just like to win most of the time, right? If we don't win, we're going to feel affected by it. So if you have a very high win rate, it also means that your losing streaks is going to be very, very short. So over here, I have the probability table. So basically what this table is showing is the probability of X consecutive losing trades within a 100 trade sequence. So within 100 trades, how many consecutive losers you will have in a row. So because this strategy has a win rate of above 90%, so we're looking at the one that I've already highlighted in blue, right? So as you can see down here at 90% and 95%, the chances of you getting 4 losses in a row is very little, right? It's anywhere from 0% to 1%. So basically, it's very improbable, which also means that you already know what to expect upfront from the strategy, right? You know that you will unlikely get 4 losses in a row. So if you're going to get up to 2 losses in a row or 3 losses in a row, you know that you're still within the boundaries of this strategy working, right? Only if you get about 4 losses in a row onwards, then you know that maybe something is not right, right? Maybe you have done something wrong. But for the most part, it should be only up to 3 losses in a row. And if you get a 95% construct, you notice that generally you will get up to only 2 losses in a row, because the 3 losses in a row is about 1%, right? Not that it won't happen, it's just that it's very, very improbable. So if you like to win most of the time, you like to have a profitable trade most of the time, and you don't like to see drawdowns, then this is a strategy that you can certainly consider. Now, the third pro is that this strategy is omnidirectional. So it's very similar to the put ratio spread, right? In the sense whereby you can make money regardless if the market goes up or down, right? So as you can see down here, this is where the current market price is. If the market goes up, you're going to make a profit because you have the credit from, creating this structure in the first place, right? This is a premium selling strategy. So you just get the minimum premium. And if the market goes down, as long as it stays above this break-even zone at expiration, then you're going to be in a profit as well, right? And you can start to make slightly more if it starts to go inside this profit zone down here. So this is the max profit zone. So as you can see, if the market goes up, you make the minimum credit. If the market goes down, you have the opportunity to make slightly more than the minimum credit. And it's a pretty, big room. So the market goes up or down, you can make profit. Just that you don't want the market to go too far down, right? Past this break-even point down here. So if you go past this break-even point, this is where you start to lose money. Now that we know the pros of this strategy, let's get into the cons. So the cons, the very first one is the loss, right? Because you have two short puts right now. So your loss really increases rapidly as the market keeps going down, right? So if the market keeps going down, you can see that this is a pretty steep decline down here, where you start to lose pretty quickly. Now, the next con is that this is pretty capital intensive because there's two naked puts, right? There's two naked puts. And as you can see down here, I'm using this on the IWM, right? If you use this on the IWM, you notice that the buying power effect is roughly about $3,442. So if you have a small account, let's say, for example, you only have $5,000 to start off with, then this strategy will definitely be a little bit too big for your account. Now, you might be thinking, hey, you could just go for a cheaper stock. So this way your buying power effect is lower. But one issue is that it can be difficult to construct on lower price stock because it has very large intervals between the strikes. So as you can see down here, the very first one at the top, this is Starbucks, right? So Starbucks is roughly about $90 odd. But at $90 odd, you notice your interval is $5 wide, right? As you can see down here, 90 to 85 to 80 to 75, these are $5 wide. So if it's $5 wide, it's going to be very difficult for you to construct this 112 strategy. So if you just take a look at a very simple example down here. So let's say, for example, let's take a look at the 80 strike to sell the two short puts. You notice that this is at 9 delta, which is roughly what the strategy is selling their puts at, around 5 to 10 deltas. So if you were to sell this, and let's say, for example, you get about 50 cents per short put. So you're going to only get a credit of $1. And let's say you're going to buy the put spread of 90 and 85. So 90 and 85, you just take the difference, right? You can see the mark for the 90 is $2.60, and the mark for the 85 strike price is $1.14. So you take $2.60 minus $1.14, it's roughly about $1.46. So that way exceeds the $1 credit that you're getting. So that means that it will actually be a debit. So in order for you to do this strategy, you may need to go for something like the 113 or the 114, where you're going to have 3 or 4 short puts. So as you can see, it's not that feasible. Same thing as well for Nike. Nike is about $100 at this point in time. And if you want to construct this as well, you notice that the intervals is about $2.50, slightly better than Starbucks. But then again, it's a little bit too wide as well to construct this 112 strategy properly. So now that you know the pros and cons, should you actually trade this strategy? So this really comes down to you and whether you're comfortable with the risks associated with this strategy. Now, if you have already decided to trade this strategy, then I'm going to share with you a few simple steps on how you can actually trade this strategy. So the very first step is to choose the closest to the 45 DTE expiration. And again, we want to choose around the 45 DTE because studies have shown this is the DTE that we have the edge, whereby the realized move is most often the time going to be lesser than the expected move. So if you're not sure what this is, again, just go ahead to my channel and I talk about this expected move in depth in another my video called the #1 secret to becoming consistently profitable trading options. Now, step number 2 is to choose 2 short puts at around 5 to 10 deltas. So as you can see down here, we have a pretty wide range of strikes that we can choose from. Now, step number 3, this is where you want to construct your put spread, right? So you've already got the 2 short puts. You want to take a look at the kind of credit that you're receiving. So once you've got the credit, you already know how much you have in terms of the premium you collected. Then you can calculate as well, how wide of a put spread you can actually put on, right? How big of a put spread you can actually purchase. And this is where you want to, just play around with the strikes. So basically for the long put, you want it anywhere from 25 to 45 deltas, right? So 45 deltas, that means that your max profit zone will be closer to where the current at the money is, but that also means that you will collect slightly lesser credit upfront. And if you go for the one that's slightly further away from the markets, maybe somewhere around 25 delta, then you're going to get slightly more credit, but your max profit zone will only be much lower. So step number 4, this is where you want to try out the different put spread strikes to find your desired construct. So for example, down here, you can see that I chose the 195, 194, as well as the 2 short puts is at 170, right? So I use the 2 short puts at 170 to finance this put debit spread at 195, 194, and you can see the credit that's received is about 73 cents or about $73. Now you want to try and shift the strikes a little bit again and then see what you can get. So for this time, we try out a 2-point wide debit spread. So as you can see down here, this is from 195 to 193. And for this, we get a slightly lower credit. We have about 30 cents, which is $30. That means to say that if the market goes above this 195 long put strike, then you're just only going to get $30, right, which is the minimum. But if it goes below 195 and let's say it stays there at expiration, then you get much more, right? The max profit will be the max profit of this credit spread, which is 2-point wide, and that is equal to $200. So $200 plus $30 for the premium you receive upfront is about $230. Next, you can try out also a put debit spread that is further out of the money, right? So in this case, you can see that I've constructed the 3-point wide debit spread, and you can only do this if you go further out of the money because the strikes are cheaper, right? If it's cheaper, you can construct a much wider profit zone for the debit spread. So as you can see down here, this is 192 to 189. And the credit that you receive is $18. So you get very little upfront. But if the market goes down below 192 to 189, past 189 will be where your max profit is. But anywhere past 192, you will get more than the minimum profit. So for this, your max profit will be $300 plus the $18, which is $318. Now, what if you go for a put debit spread that is much further out of the money, right? So in this case, you can see I used the 190, 189. So for this, what you're doing is that you're slightly more bullish, whereby you get much more credit upfront. As you can see, you get $89 upfront. And if the market goes down below 189, then your max profit will be only about $189. So as you can see down here, there's a lot of tinkering around with the strikes, right? You just have to shift it here and there, and then find out one that is comfortable for you, right? Which you feel is the construct that you want, right? So for example, if you're a little bit more bullish, then you may want to go with one that has a slightly higher credit. If you're slightly more bearish, then you want to go with one where there is a wider put debit spread. So this way, if the market goes down, at least you have a bigger protection to the downside with the higher profit from the put debit spread. Now, once you're satisfied with this construct, the last step is to submit your order as a single order ticket. So this is very important because some people have asked me whether it's possible to split up the strategy. So basically split it up by selling the short put first, and if the market goes higher, then you go and buy the put debit spread. And while you can certainly do that, but you need to understand that there'll be lagging risk, right? Because if, for example, you sell the short put, the market goes down, then you're going to be, shortchanging yourself because you're going to buy a debit spread that is much lower when we could actually got it higher. All right, so this is the 112 option strategy. What do you think about it? And do you think you're going to trade it? Do let me know in the comments below. I'd love to hear what you think. And as always, if you like this video, please give me a thumbs up. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. All right, I will see you in the next video.